Section 3.1 to 3.4 Fundamental Analysis. 3.1 Liquidity Ratios. The current ratio, quick ratio, and cash ratio are liquidity ratios that assess a company's ability to cover its short-term obligations with its available liquid assets. Here's an overview of these ratios. Current ratio. Formula. Current ratio equals current assets / current liabilities. Purpose. The current ratio measures the company's short-term liquidity by comparing its current assets expected to be converted into cash within 1 year, to its current liabilities, obligations due within 1 year. It provides an indication of the company's ability to meet its short-term obligations. A current ratio higher than 1 indicates that the company has more current assets than current liabilities, suggesting better liquidity. Generally, a ratio above 1.5 is considered favorable, but the ideal current ratio varies across industries. Quick ratio, also known as acid test ratio. Formula. Quick ratio equals current assets, inventory, / current liabilities. Purpose. The quick ratio provides a more conservative measure of liquidity by excluding inventory from current assets. It focuses on assets that can be quickly converted into cash to meet short-term obligations. Since inventory may not be easily converted into cash, excluding it from the calculation provides a more immediate liquidity assessment. A higher quick ratio indicates stronger short-term liquidity. A ratio above 1 is generally considered favorable, indicating that the company can cover its short-term obligations without relying heavily on inventory. Cash ratio. Formula. Cash ratio equals cash and cash equivalents / current liabilities. Purpose. The cash ratio is the most conservative measure of liquidity, as it considers only cash and cash equivalents in relation to current liabilities. It provides insights into the company's ability to cover immediate obligations solely with cash on hand. A higher cash ratio indicates a stronger ability to meet short-term obligations using available cash. While there is no specific benchmark for the cash ratio, a ratio above 0.2, 20%, is generally considered favorable. These liquidity ratios help assess a company's ability to meet its short-term financial obligations. However, it's important to consider industry norms, the company's specific circumstances, and the nature of its operations. Comparing these ratios over time, against industry peers, and in conjunction with other financial metrics provides a more comprehensive analysis of the company's liquidity position. Liquidity ratios provide insights into a company's ability to meet its short-term financial obligations. Interpreting and understanding these ratios is crucial in assessing the company's liquidity position and financial health. Here's the interpretation and significance of liquidity ratios. Current ratio. Interpretation. A current ratio higher than 1 indicates that the company has more current assets than current liabilities, suggesting it has sufficient liquidity to meet short-term obligations. A ratio below may first indicate potential liquidity issues and the company may struggle to pay its short-term debts. Significance. The current ratio provides a general measure of a company's short-term liquidity. It helps assess the company's ability to manage its working capital and meet its near-term financial obligations. However, it doesn't consider the composition or quality of current assets, such as the ease of converting them into cash. Quick ratio. Acid test ratio. Interpretation. The quick ratio excludes inventory from current assets, focusing on assets that can be quickly converted into cash. A higher quick ratio suggests stronger short-term liquidity and a greater ability to meet obligations without relying heavily on inventory. Significance. The quick ratio provides a more conservative measure of liquidity, as it considers the most liquid assets. It helps evaluate a company's ability to meet short-term obligations even in situations where inventory may not be easily converted into cash. It is particularly important for companies with slow-moving or specialized inventory. Cash ratio. Interpretation. The cash ratio measures the company's ability to cover immediate obligations solely with cash and cash equivalents. A higher cash ratio indicates a stronger ability to meet short-term obligations using available cash. Significance. The cash ratio provides the most conservative assessment of liquidity. It focuses solely on cash, which is the most liquid asset. A high cash ratio indicates a company's ability to handle unexpected expenses, emergencies, or periods of low cash flow. However, it's important to note that excessively high cash ratios may suggest inefficient deployment of cash resources. Interpreting liquidity ratios requires considering industry benchmarks, historical trends, and the company's specific circumstances. A company's liquidity position can impact its ability to fund operations, meet financial obligations, and seize growth opportunities. Insufficient liquidity may lead to difficulties in paying suppliers, servicing debt, or taking advantage of favorable market conditions. On the other hand, excessive liquidity may suggest that the company is not efficiently utilizing its resources and could benefit from investing or deploying excess cash. It's important to evaluate liquidity ratios in conjunction with other financial indicators and qualitative factors to gain a comprehensive understanding of a company's financial health and liquidity position. Assessing a company's short-term financial health involves evaluating its ability to meet its immediate financial obligations and manage its short-term liquidity. Here are key factors and metrics to consider when evaluating a company's short-term financial health: liquidity ratios. Current ratio. Evaluate the company's current assets relative to its current liabilities. A ratio above 1 suggests sufficient liquidity to cover short-term obligations. However, a very high current ratio may indicate inefficient use of assets. Quick ratio. Assess the company's ability to meet short-term obligations using its most liquid assets, excluding inventory. A ratio above 1 indicates better short-term liquidity. Cash ratio. Measure the company's ability to cover immediate obligations solely with cash and cash equivalents. A higher cash ratio suggests stronger short-term liquidity. Working capital management. Days sales outstanding, DSO. Analyze the average number of days it takes the company to collect payment from its customers. A lower DSO indicates better management of accounts receivable and faster cash conversion. Days inventory outstanding, DIO. Evaluate the average number of days it takes the company to sell its inventory. A lower DIO suggests efficient inventory management and faster conversion into cash. Days payable outstanding, DPO. Assess the average number of days the company takes to pay its suppliers. A higher DPO indicates better management of payables and potential for improved cash flow. Debt levels and debt maturity. Debt-to-equity ratio. Evaluate the company's level of debt relative to its equity. Excessive debt levels may increase financial risk and affect short-term financial health. Debt maturity profile. Analyze the maturity dates of the company's debt obligations. A well-spread and manageable debt maturity schedule reduces the risk of facing a large number of debt repayments in the short term. Cash flow from operations. Assess the company's ability to generate cash from its core operations to cover short-term obligations. Free cash flow. Evaluate the company's capacity to generate cash after accounting for capital expenditures. Positive free cash flow suggests potential for internal funding meeting short-term obligations. Access to credit facilities. Evaluate the company's ability to secure credit facilities, lines of credit, or other short-term financing options to meet unexpected shortfalls or capitalize on growth opportunities. Financial ratios. Interest coverage ratio. Assess the company's ability to cover interest expenses with its operating cash flow. Current liabilities to net worth ratio. Evaluate the proportion of current liabilities to the company's net worth. A high ratio may indicate financial strain. Assessing short-term financial health requires analyzing a combination of liquidity ratios, cash flow metrics, working capital management, debt levels, and overall financial ratios. It's important to consider industry benchmarks, historical trends, and the company's specific circumstances to gain a comprehensive understanding of its short-term financial health. Additionally, qualitative factors such as market conditions, competitive landscape, and management strategies should be taken into account to assess the company's ability to navigate short-term challenges and seize opportunities. 3.2 Profitability ratios. Gross profit margin, operating profit margin, and net profit margin are profitability ratios that help evaluate a company's financial performance and efficiency in generating profits. Here's an overview of each ratio. Gross profit margin. Formula: gross profit margin equals gross profit/revenue x 100. Purpose: the gross profit margin measures the percentage of revenue that remains after deducting the cost of goods sold, COGS. It indicates how efficiently a company generates profits from its direct production or service costs. Interpretation: A higher gross profit margin indicates that the company has a higher proportion of revenue available to cover operating expenses and generate operating profit. It reflects the company's ability to price its products or services appropriately and control direct production costs. Operating profit margin formula: operating profit margin equals operating profit/revenue x 100. Purpose: the operating profit margin measures the percentage of revenue that remains after deducting both COGS and operating expenses, including selling, general, and administrative expenses, SG&A. It evaluates the company's ability to manage and control its operating expenses. Interpretation: a higher operating profit margin indicates better operational efficiency and cost management. It shows how effectively the company is generating profits from its core operations before considering non-operational factors such as interest and taxes. Net profit margin formula: net profit margin equals net profit/revenue x 100. Purpose: the net profit margin measures the percentage of revenue that remains as net profit after deducting all expenses, including COGS, operating expenses, interest expenses, taxes, and other non-operational items. Interpretation: the net profit margin reflects the overall profitability and efficiency of the company, considering all expenses and non-operational factors. A higher net profit margin indicates stronger profitability, as the company generates a larger portion of revenue as net profit. These profitability margins are important indicators of a company's financial performance. They provide insights into the company's ability to generate profits at different stages of the business operation. Comparing these ratios over time and against industry benchmarks can help evaluate a company's profitability relative to its peers. However, it's important to consider the industry, business model, and other contextual factors when interpreting profitability ratios, as different industries may have varying profit margin standards. Return on assets, ROA, and return on equity, ROE, are key financial ratios that measure a company's profitability and efficiency in generating returns for its shareholders. Here's an overview of each ratio. Return on assets, ROA, formula: ROA equals net income/average total assets, x 100. Purpose: ROA measures the company's ability to generate profits from its total assets, including both tangible and intangible assets. Interpretation: ROA indicates how efficiently the company utilizes its assets to generate profits. A higher ROA suggests better asset utilization and profitability. It reflects the company's ability to generate earnings relative to the size of its asset base. Return on equity, ROE, formula: ROE equals net income/average shareholders' equity, x 100. Purpose: ROE measures the return generated for shareholders' investments in the company. Interpretation: ROE indicates how effectively the company generates profits for its shareholders based on the equity invested. A higher ROE suggests better profitability and efficiency in utilizing shareholders' equity. It reflects the company's ability to generate a return on the capital invested by shareholders. Interpreting ROA and ROE, both ratios are expressed as a percentage and provide insights into a company's profitability and efficiency. Higher ROA and ROE generally indicate better financial performance and efficiency. ROA focuses on the overall asset base, while ROE specifically measures the return generated for shareholders. Comparing ROA and ROE with industry benchmarks and historical performance helps evaluate a company's profitability and efficiency relative to its peers. It's important to consider industry norms and variations, as different industries may have different levels of profitability and asset utilization. ROE can be influenced by factors such as debt levels and leverage. Higher levels of debt may amplify returns but also increase financial risk. It's worth noting that ROA and ROE should not be the sole determinants of a company's financial health and investment potential. They should be evaluated alongside other financial metrics, industry trends, and qualitative factors to gain a comprehensive understanding of a company's performance, profitability, and the value it delivers to its shareholders. Comparing profitability ratios across companies and industries can provide valuable insights into a company's relative performance and help assess its profitability in relation to its peers. Here are some considerations when comparing profitability ratios. Industry norms. Profitability ratios can vary significantly across industries due to differences in business models, cost structures, and market dynamics. It's important to consider industry-specific benchmarks and understand the typical profit margins and efficiency levels for companies operating in the same industry. Historical trends. Assessing a company's profitability ratios over time allows for an evaluation of its performance and identifies trends. Comparing current ratios to historical data provides insights into the company's ability to maintain or improve profitability. Peer comparison. Comparing profitability ratios with industry peers helps gauge how a company's profitability stacks up against its competitors. This analysis can reveal whether a company is outperforming or underperforming its peers in terms of profitability, size, and scale. Profitability ratios can vary based on the size and scale of a company. Larger companies may have economies of scale that allow for higher profitability, while smaller companies may have more flexibility and agility. When comparing profitability ratios, it's important to consider the size and scale of the companies being analyzed. Business models. Different business models within the same industry can result in varying profitability ratios. For example, a company focused on high-volume sales may have a different profit margin compared to a company focused on premium products or services. Understanding the nuances of different business models is essential for meaningful comparisons. Additional factors. Profitability ratios should be evaluated in conjunction with other financial metrics, such as liquidity ratios, solvency ratios, and growth indicators, to gain a comprehensive understanding of a company's financial health and performance. It's important to note that profitability ratios alone may not provide a complete picture of a company's financial performance or investment potential. Other qualitative factors, such as management quality, competitive advantages, market conditions, and industry trends, should also be considered when comparing profitability across companies and industries. 3.3 Efficiency ratios. Asset turnover ratio. The asset turnover ratio measures a company's efficiency in generating revenue from its total assets. It indicates how well a company utilizes its assets to generate sales. The formula for the asset turnover ratio is, asset turnover ratio equals net sales/average total assets. A higher asset turnover ratio suggests better asset utilization and efficiency in generating sales. It shows how effectively a company generates revenue relative to the size of its asset base. However, the interpretation of this ratio can vary depending on the industry. For example, industries with high capital requirements, such as manufacturing, may have lower asset turnover ratios compared to service-based industries. Inventory turnover ratio. The inventory turnover ratio measures the efficiency with which a company manages and sells its inventory. It indicates how quickly a company's inventory is sold and replaced within a given period. The formula for the inventory turnover ratio is, inventory turnover ratio equals cost of goods sold/average inventory. A higher inventory turnover ratio suggests better inventory management and faster inventory turnover, which can lead to improved cash flow and reduced holding costs. However, a very high ratio may indicate inventory shortages, missed sales opportunities, or inadequate inventory levels to meet customer demand. Industries with perishable or fast-moving inventory, such as retail or food service, generally have higher inventory turnover ratios compared to industries with slower-moving inventory. Receivables turnover ratio. The receivables turnover ratio measures how quickly a company collects payments from its customers. It assesses the efficiency of the company's credit policies, collection processes, and the quality of its accounts receivable. The formula for the receivables turnover ratio is, receivables turnover ratio equals net credit sales/average accounts receivable. A higher receivables turnover ratio indicates faster collection of receivables, which improves cash flow and reduces the risk of bad debts. However, a very high ratio may suggest overly strict credit policies that could hinder sales. Conversely, a low ratio may indicate inefficient collection processes or poor credit management. The interpretation of the receivables turnover ratio should consider industry norms, payment terms, and the company's specific circumstances. Interpreting these turnover ratios involves comparing them to industry benchmarks, historical trends, and considering the company's business model and industry dynamics. Analyzing these ratios helps assess a company's efficiency in utilizing its assets, managing inventory, and collecting receivables, which are crucial factors in maintaining a healthy cash flow and optimizing profitability. Days Sales Outstanding, DSO. days sales outstanding, DSO. Also known as the average collection period, measures the average number of days it takes for a company to collect payment from its customers after a sale is made. DSO indicates the efficiency of a company's credit and collection policies and reflects the effectiveness of its accounts receivable management. The formula for calculating DSO is, DSO equals, average accounts receivable / net credit sales, X number of days. A lower DSO indicates faster collections and better cash flow management. However, a very low DSO may indicate overly restrictive credit policies that could negatively impact sales. Conversely, a high DSO may suggest inefficient collection processes, potential cash flow problems, or a higher risk of bad debts. Comparing DSO to industry averages and historical trends is essential to determine the effectiveness of a company's credit management. Days Inventory Outstanding, DIO. Days Inventory Outstanding, DIO, measures the average number of days it takes for a company to sell its inventory. It assesses the efficiency of inventory management and reflects the company's ability to convert inventory into sales. The formula for calculating DIO is, DIO equals, average inventory / cost of goods sold, X number of days. A lower DIO suggests better inventory management and faster turnover, which can lead to improved cash flow and reduced holding costs. However, an excessively low DIO may indicate stockouts, missed sales opportunities, or inadequate inventory levels to meet customer demand. Conversely, a high DIO may suggest overstocking or slow-moving inventory, which ties up capital and increases the risk of obsolescence. Interpreting DSO and DIO involves comparing them to industry benchmarks, historical trends, and considering the company's specific circumstances. It's important to note that different industries have different norms for DSO and DIO due to variations in business models and supply chain dynamics. Analyzing these ratios helps evaluate a company's effectiveness in collecting receivables, managing inventory levels, optimizing cash flow, and identifying areas for improvement in working capital management. Evaluating a company's operational efficiency and asset utilization is crucial in assessing its overall financial health and performance. Several financial ratios can provide insights into these areas. Here are some key ratios to consider. Asset turnover ratio. The asset turnover ratio measures how effectively a company utilizes its assets to generate sales. It indicates the efficiency of asset utilization. A higher ratio suggests better operational efficiency and effective use of assets to generate revenue. Inventory turnover ratio. The inventory turnover ratio measures how efficiently a company manages its inventory. It indicates how quickly inventory is sold and replaced within a given period. A higher ratio suggests better inventory management and efficient use of working capital. Receivables turnover ratio. The receivables turnover ratio assesses the efficiency of a company's credit policies and collection processes. It measures how quickly the company collects payments from customers. A higher ratio indicates faster collection of receivables, which improves cash flow and reduces the risk of bad debts. Fixed asset turnover ratio. The fixed asset turnover ratio measures how efficiently a company uses its fixed assets, such as property, plant, and equipment, to generate sales. It indicates the effectiveness of the company's long-term asset investments in generating revenue. Sales growth rate. The sales growth rate shows the rate at which a company's sales revenue is growing over a specific period. It indicates the company's ability to increase its market share and capture new business opportunities. Operating cycle. The operating cycle represents the time it takes for a company to convert its resources, example, inventory, into cash through sales. It includes the time for inventory conversion, accounts receivable collection, and payment of accounts payable. A shorter operating cycle suggests better operational efficiency and cash flow management. By analyzing these ratios and comparing them to industry benchmarks, historical trends, and peer companies, investors and analysts can evaluate a company's operational efficiency, asset utilization, and overall effectiveness in generating revenue and managing resources. It is important to consider the industry dynamics and specific circumstances of the company being analyzed to gain a comprehensive understanding of its operational performance. 3.4 Solvency ratios. Debt-to-equity ratio. The debt-to-equity ratio measures the proportion of a company's financing that comes from debt relative to equity. It indicates the extent to which a company relies on borrowed funds compared to the funds provided by shareholders. The formula for calculating the debt-to-equity ratio is, debt-to-equity ratio equals total debt/shareholders' equity. A higher debt-to-equity ratio indicates a higher level of financial leverage and potential risk. It suggests that a larger portion of the company's financing is derived from debt, which may result in higher interest payments and financial obligations. A lower debt-to-equity ratio indicates a lower level of debt relative to equity, which may imply a more conservative financial structure. Debt ratio, the debt ratio, sometimes referred to as the total debt ratio or debt-to-assets ratio, measures the proportion of a company's assets that are financed by debt. It assesses the overall debt burden of a company relative to its total assets. The formula for calculating the debt ratio is debt ratio equals total debt/total assets. The debt ratio provides insights into the company's financial risk and the proportion of its assets that are financed through debt. A higher debt ratio suggests a greater reliance on debt financing, which can increase financial risk. Conversely, a lower debt ratio indicates a lower level of debt in proportion to the company's assets. Interest coverage ratio, the interest coverage ratio, also known as the times interest earned ratio, evaluates a company's ability to meet its interest obligations with its earnings. It measures the company's ability to cover interest expenses with its operating income. The formula for calculating the interest coverage ratio is interest coverage ratio equals earnings before interest and taxes, EBIT/interest expenses. A higher interest coverage ratio indicates a better ability to meet interest payments and suggests a lower financial risk. It demonstrates that the company's earnings are sufficient to cover its interest obligations. A lower interest coverage ratio may indicate a higher risk of defaulting on interest payments. Interpreting these ratios requires considering the industry norms, company's business model, and financial strategy. Comparing these ratios to industry benchmarks, historical trends, and peer companies provides insights into a company's financial risk, capital structure, and ability to meet its debt obligations. It's important to note that debt ratios and interest coverage ratios should be analyzed alongside other financial metrics to gain a comprehensive understanding of a company's financial health and risk profile. Assessing a company's long-term solvency and leverage is crucial to understanding its ability to meet its long-term financial obligations and manage its debt effectively. Here are some key factors to consider when evaluating a company's long-term solvency and leverage. Debt-to-equity ratio. The debt-to-equity ratio measures the proportion of a company's financing that comes from debt relative to equity. A higher ratio indicates a higher level of leverage and potential financial risk, as the company relies more on borrowed funds. It is important to compare the company's debt-to-equity ratio to industry averages and peers to assess its relative level of leverage. Debt ratio. The debt ratio, also known as the total debt ratio or debt-to-assets ratio, measures the proportion of a company's assets that are financed by debt. A higher debt ratio suggests a greater reliance on debt financing, which can increase financial risk. It is essential to analyze the trend of the company's debt ratio over time and compare it to industry benchmarks to understand its solvency position. Interest coverage ratio. The interest coverage ratio evaluates a company's ability to meet its interest obligations with its earnings. A higher ratio indicates a better ability to cover interest expenses with operating income, which is a positive sign of solvency. It is important to assess the company's interest coverage ratio over time and compare it to industry averages to ensure it can comfortably meet its interest payments. Debt maturity profile. Assessing the maturity profile of a company's debt helps understand its ability to manage its debt repayment obligations over the long term. A well-diversified and staggered debt maturity profile reduces the risk of a company facing significant debt repayment obligations at once. Cash flow generation. Analyzing a company's cash flow generation, specifically its ability to generate consistent and sufficient cash flows from its operations, is crucial in evaluating its long-term solvency. Strong operating cash flows indicate the company's ability to generate the necessary funds to meet its debt obligations and invest in growth. Credit ratings. Monitoring a company's credit ratings provided by reputable credit rating agencies can provide insights into its long-term solvency and creditworthiness. Higher credit ratings generally indicate a lower risk of default and better long-term solvency, when assessing a company's long-term solvency and leverage, it's essential to consider the specific characteristics of the industry, economic conditions, and the company's competitive position. It is also important to analyze the company's financial statements. Review its debt agreements and covenants, and conduct a thorough qualitative analysis to gain a comprehensive understanding of its long-term financial health and ability to manage its debt obligations effectively. Comparing solvency ratios within the industry and against benchmarks is a valuable practice in assessing a company's financial health and its ability to meet long-term financial obligations. Here's how you can perform such a comparison: gather industry data. Obtain solvency ratio data for companies within the same industry as the one you are analyzing. Industry-specific databases, financial publications, and regulatory filings can be excellent sources for this information. Ensure that the companies you compare are of similar size and operate in similar markets to make the comparison more meaningful. Calculate industry averages. Calculate the average solvency ratios for the companies within the industry you are examining. This can be done by summing up the solvency ratios of all the companies in the industry and dividing by the number of companies. This average will serve as a benchmark against which you can compare the individual companies' ratios. Compare individual company ratios. Compare the solvency ratios of the company you are analyzing to the industry average. If the company's ratios are consistently higher than the industry average, it may indicate a stronger financial position and better long-term solvency. Conversely, if the ratios are consistently lower, it may suggest a higher level of financial risk. Consider variations by company size. Keep in mind that solvency ratios can vary depending on the size of the company. Larger companies may have different debt levels and capital structures compared to smaller companies. Therefore, it can be helpful to compare the ratios of the company in question to companies of a similar size. Use benchmarking data. In addition to industry averages, you can also refer to external benchmarks such as published industry reports or financial benchmarks provided by reputable organizations. These benchmarks provide broader comparisons and can help assess the company's solvency performance relative to the wider market. Analyze trends. It's important to analyze solvency ratios over time to identify any improving or deteriorating trends. Comparing a company's solvency ratios to its own historical performance can provide insights into its financial stability and long-term sustainability. Consider qualitative factors. While comparing solvency ratios, don't overlook qualitative factors such as the company's growth prospects, competitive position, and management strategies for managing debt and liquidity. These factors can impact a company's solvency even if its ratios appear favorable or unfavorable compared to industry averages. Comparing solvency ratios within the industry and against benchmarks helps identify whether a company's solvency position is stronger or weaker relative to its peers. However, it is important to consider the unique characteristics and circumstances of the company being analyzed to gain a comprehensive understanding of its financial health and long-term viability.